Welcome to our comprehensive GBP/USD analysis for the week of October 27th through November 1st, 2025. This was a pivotal week for sterling, marked by dramatic price action and significant policy developments. We'll examine how the Federal Reserve's hawkish surprise, combined with mounting UK fiscal concerns, drove the pound to six-month lows against the dollar. Our analysis integrates technical insights from 5 leading sources: TradingView, investingLive, ActionForex, Forex.com, and Daily Forex to provide you with actionable trading strategies. We'll explore the critical support zones, assess both near-term and medium-term outlooks, and identify key risk factors that could shape the pair's trajectory in the coming weeks. Whether you're a trend trader, range trader, or swing trader, this analysis will equip you with the insights needed to navigate these uncertain waters. Let's dive in. British pound to US dollar closed the week at 1.31485, down 1.30% from the previous week's close. The pair experienced violent downward pressure, plunging from 1.33500 to a six-month low of 1.30970. This represents a staggering 4.9% decline from the yearly highs reached in September. The weekly range spanned 1.30970 to 1.33700, reflecting extreme volatility. Despite the sharp decline, technical indicators have now turned neutral, suggesting a potential consolidation phase at these depressed levels. The pair's one-month performance shows a 2.43% loss, while the six-month change stands at negative 0.84%. However, year-to-date, GBP/USD remains up 5.09%, indicating that the recent sell-off has merely erased gains from October and early November. Trading volume surged to 209.79K as the breakdown attracted significant selling pressure. The key question now: is this a medium-term top, or simply a correction before the next leg higher? On October 29th, the Federal Reserve delivered a 25 basis point rate cut, bringing the target range to 3.75 to 4.00%. However, it was Fed Chair Powell's messaging that shocked markets. While the cut itself was widely expected, Powell described it as potentially the last for the near term, creating immediate uncertainty about December's meeting. His emphasis on data dependency, complicated by the ongoing U.S. government shutdown, left markets with no clear path forward. The decision passed with a 10-2 vote, showing some internal dissent. Powell's refusal to commit to additional easing disappointed traders who had priced in a more dovish stance. The market reaction was swift and brutal. GBP/USD plummeted over 200 pips in just 48 hours. Dropping from 1.33000 pre-Fed to 1.32000 immediately after, and eventually reaching 1.30970 by Friday. This hawkish surprise strengthened the dollar across the board. 3 major news events shaped the week. First, the U.S.-China trade deal initially provided risk on sentiment. China agreed to purchase 25 million metric tons of U.S. soybeans, suspend rare earth export controls, and curb fentanyl precursor chemicals. This briefly supported sterling. Second, the ongoing U.S. government shutdown entered its critical phase, costing an estimated $15 billion weekly, with 10,000 workers fired and crucial NFP data delayed. This created significant uncertainty around Fed policy. Third, and most damaging for sterling, UK fiscal concerns intensified ahead of the November 26th autumn budget. Chancellor Reeves acknowledged considering tax rises on pension contributions and capital gains, alongside spending cuts. GBP fell to a 2-month low against the euro as investors worried about the government's ability to manage public finances without harming growth. Ultimately, UK fiscal worries overwhelmed any positive sentiment from the trade deal. All 5 of our technical sources converge on a bearish, near-term outlook. TradingView shows neutral indicators following the sharp decline, with oscillators and moving averages balanced after the violent move. InvestingLive identifies a daily range of 1.3140 to 1.3588, noting the pair broke its downward trend line and failed at 1.3360 resistance before the breakdown. ActionForex highlights a critical double top formation at 1.3787/1.3725, with the pair breaking below the 38.2% retracement at 1.3142. Their measured move targets 1.2744 at the 61.8% retracement level, with the 55-week EMA at 1.3185 now acting as resistance. Forex.com notes the 3% weekly decline from October highs, identifying key support at 1.3080/88, where the 52-week moving average resides. Finally, Daily Forex emphasizes the violent downward velocity, projecting a range of 1.2910 to 1.3310 with 1.3000 as a potential psychological support target. The consensus is clear. Bearish momentum dominates. 3 critical support zones define the downside risk. The immediate focus is 1.3080 to 1.3140, where the 52-week moving average, 38.2% retracement, and May to July lows converge. This is the current line of defense. If that fails, the primary target becomes 1.2944, the 50% retracement level, and 25% parallel convergence zone. An extended move could reach 1.2744, the 61.8% retracement representing the double top measured move. On the upside, initial resistance sits at 1.3247 to 1.3280, former support turned resistance at the July low week close. The critical bearish invalidation level is 1.3434 to 1.3469, the 2024 swing high and September high week close. A break above this would suggest a significant low is in place. Major resistance beyond that lies at 1.3648, the yearly high week close. The trading implication is clear. A daily close below 1.3080 confirms the next leg lower toward 1.2944. For the next 1 to 2 weeks, we assign a 70% probability to the bearish scenario. This envisions failure to hold 1.3080 support, leading to targets at 1.2944 and potentially 1.2744 with an extreme downside objective at the 1.3000 psychological level. Key catalysts include a potential Boe dovish surprise on November 7th, weak UK GDP data between November 8th to 10th, continued U.S. government shutdown, escalation of UK fiscal concerns, and strong U.S. data supporting Fed caution. The bullish scenario carries just 30% probability, requiring support to hold at 1.3080 to 1.3140 and a bounce toward 1.3247 to 1.3280, with a break above 1.3434 needed for full invalidation. Bullish catalysts would include the BOE maintaining a hawkish stance, positive UK economic surprises, US shutdown resolution, or FED signaling openness to a December cut. Key events include US ADP employment on November 6th, the Bank of England decision on November 7th, UK GDP and manufacturing data November 8th to 10th, and ongoing shutdown developments. Looking at the medium term, central bank policy divergence has become the dominant theme. Bank of England expectations have shifted dramatically dovish, with markets now pricing 17 basis points of easing by year-end, up from 11 basis points just a week ago. Cumulative easing expectations through end 2026 have jumped to 63 basis points from 50 basis points. The December meeting is now considered live for a potential cut following soft UK CPI data. Meanwhile, Federal Reserve expectations show 47 basis points of easing priced by year-end, but December is no longer guaranteed. The Fed's data-dependent approach has been complicated by the government shutdown, and Powell's stance is more cautious than earlier in October. This widening gap in policy expectations creates a bearish backdrop for sterling. If the BOE is forced to cut more aggressively, while the Fed maintains caution, GBP/USD faces sustained downward pressure. The medium-term direction hinges on whether this divergence materializes or reverses. 3 scenarios emerge for the next 1 to 3 months. The bearish scenario carries 55% probability, requiring sustained trading below the 55-week EMA at 1.3185 to confirm a medium-term top. Targets would be 1.2744, then 1.2099, potentially reaching 1.2500 over 2 to 4 months. This scenario assumes the BOE is forced to cut aggressively while the Fed maintains caution. The bullish scenario, at 25% probability, requires reclaiming the 1.3434/69 bearish invalidation level, targeting 1.3648, 1.3787, and potentially 1.4000, resuming the broader uptrend from the 2022 low. This requires the BOE to stay hawkish while the Fed resumes aggressive easing. The range-bound scenario carries 20% probability, envisioning trading between 1.2744 and 1.3434, a roughly 700 pip range oscillation lasting 1 to 3 months if both central banks remain data-dependent without clear signals. Critical factors to monitor include the UK autumn budget on November 26th, US shutdown resolution timing, UK economic data trajectory, and clarity from both central banks. We provide 3 trading approaches for different trader types. Trend traders should consider a bearish setup with entry below 1.3080, stop above 1.3200, targeting 1.2944 and 1.2744, offering 1 to 2 to 1 to 3 risk reward. The bullish setup requires entry above 1.3280, stop below 1.3140, targeting 1.3434 and 1.3588, with 1 to 1.5 to 1 to 2 risk reward. Range traders should define the 1.3080 to 1.3280 range, selling at 1.3240 to 1.3280 with stops above 1.3320, targeting 1.3320 to 1.3340, 1.3080 to 1.3100, or buying at 1.3080 to 1.3100 with stops below 1.3040, targeting 1.3240 to 1.3280. Exit quickly if the range breaks. Swing traders can enter bearish swings at 1.3200 to 1.3280 with stops above 1.3350, targeting 1.2944 and 1.2744 over 2 to 4 weeks, or bullish swings at 1.3080 to 1.3140 with stops below 1.3000, targeting 1.3434 and 1.3588 over 3 to 6 weeks. Risk management is critical. Reduce position sizes by 30 to 50% given elevated volatility. Use wider stops beyond key levels, and consider reducing leverage in this uncertain environment. 6 key findings emerge from our analysis. First, GBP/USD experienced a decisive bearish break, plunging to 6-month lows and breaking the October range along with key support at 1.3142. The technical structure suggests a potential medium-term top formation. Second, the Fed delivered a hawkish surprise as Powell's caution strengthened the dollar. While the 25 basis point cut was expected, his reluctance to commit to future cuts triggered violent selling, with December no longer guaranteed. Third, UK fiscal concerns are weighing heavily on sterling, with mounting worries about the autumn budget and tax increases. The Chancellor's acknowledgement of fiscal challenges adds pressure ahead of November 26th. Fourth, the critical support zone at 1.3080 to 1.3140 represents the last defense, with a daily close below 1.3080 confirming the next leg lower. Fifth, policy divergence has shifted in favor of the USD, with markets now pricing more BOE easing and less Fed easing than earlier in October. Sixth, elevated volatility will persist given multiple catalysts ahead. Our trading guidance is clear. Maintain a bearish near-term bias, recognize that the medium-term outlook depends on central bank policies, and adopt a cautious trading approach with reduced position sizes. 4 key risk factors demand attention. A BOE dovish surprise could accelerate the decline, while the US shutdown prolongs data uncertainty. If the UK budget disappoints on the growth outlook, further sterling weakness is likely. Conversely, shutdown resolution or a BOE hawkish stance could trigger a reversal. Our final thought. The battle lines are drawn on the weekly chart. The coming weeks will determine whether GBP/USD has formed a medium-term top, or if the recent decline is merely a correction within the broader uptrend. Stay disciplined in your trading approach, manage risk carefully with appropriate position sizing and stop losses, and remain flexible as new information emerges. The market is at a critical juncture, and the next major move could define the trajectory for months to come. Thank you for watching, and trade safely.